All right. I'm going to explain you options in very simple words. Now try to understand a couple slides, because on that information, the rest of information will be built in. So I presume we're going to talk about growth strategies tonight. Options can be used for both growth and a falling market. So if the market is going to fall tomorrow, people who knows how to use options, they can make money much faster even than on the growth market. Have you seen the movie, I think Big Short? Yeah, it's called Big Short. Have you seen it? The guys made with options huge amount of money. That's how they made it. All right. So we're going to talk about call option. Call option, when you're selling call option, because there is a seller and a buyer. When you imagine that you're a seller of the call option, you're giving somebody a right to buy from you something, some security. Let's have a very simple example. Your shop owner, imagine you have your own shop and you're selling these lovely bags. Okay, and now you're running a discount. And you think, okay, fine, I'm going to sell these lovely bags and it's only one left. And lady comes to you and says, oh, I love this bag, I want to buy it, but I don't have cash on me. Can you hold it for me? And what would you say? Why should I? Because during the next 5 minutes, somebody can come and buy this bag. And she says, I'm going to pay you $50 for you to keep this bag for a week. If I don't come back in a week time, you're going to sell it. If I come back within this 7 days, I'm going to pay you $1,000. So it's not a deposit, it's an option to buy for her. She doesn't have to buy. So in this particular case, what happens? You have a contract with her. You cannot sell your bag to somebody else. You're obliged to keep this bag. You're obliged to keep this price. You cannot increase the price if she comes back. It's, you know what, I changed my mind, I'm going to sell it for $1,000. No, it's $1,000. She locked the price by paying you this deposit. Now, for you, if she doesn't come back, you can sell the bag at whatever price you went. If she comes back, you get $1,000. Is it better deal than if you decided just to sell the bag and don't go into the contract with her later? So if you just sold the bag for $1,000, you generated $1,000. But because you went into this contract, how much you got? $1,050. So it's 5% more. Is it a good or good? Maybe when you think about retail, you say, oh, it's not that great, but when you think about investment, for one deal, for 1 week, 5% is fantastic return. All right. The reason why I showed you this example, because I want to show you very important key elements of options. So first of all is the price. The set price of agreed contract. $1,000 in this particular case, on the stock market at the price of the share, basically. So it could be $2, $5, $10, depends on the price of the share at that specific moment. Now, another element is the premium, which the person paying you in this particular case, $50 in this example. When we consider stock market, it could be 10 cents, 5 cents, 20 cents, $2, different, depends on the stock, depends on the situation, depends on the duration. Another important part is underlying security. So here is a handbag. On the stock market, it's basically share. All right. Usually the options, they trade in contracts, and contracts is controlling 100 shares. Okay, but tonight I'm going to show you only calculation based on one share for simplicity reasons. So another one important, expiry date. How long is that contract valid for? So here's a week. If you go on the stock market, if you buy option or sell option today, it might be until this Friday. Majority of contracts in United States, they end up on Fridays. So it could be this Friday, next Friday. Some options have only monthly contracts. Some options have weekly contracts. Some options have annual contracts. So you might, for some shares, you buy contracts or sell contracts for 3 years. So you choose whatever contract is suitable for you. And then this specific option called option to buy, call option. There is another option called put. It would be order to sell. So now let's do the real example. If you have paper, you can record it. But if you left your details there in email, we're going to record this presentation. We're going to combine it, and I am going to email it to you. So after that, you can watch it again if you want to. All right? So selling call option. Imagine the situation. You went to the market and you bought stock, virtual stock, which costs $10. Right? When you buy a stock, what do you want the stock to do? Goes up. Okay? So in this particular case, when you trade in stocks only, you can make money only when the stock goes up. Right? I'm going to show you now how you can make money with options even if the stock doesn't go up, even if it goes down. So the next thing what you do, you go and sell call option for 50 cents. So somebody comes to you and paying you 50 cents for the right to buy your shares at $11. Why would that person want to do that?
Maybe.
Because they believe that the share price might go up and they will buy it after that, already at $11 and sell it at whatever price is that, maybe $15, $12, correct? But they don't have to put all the amount. They don't put $10, they put only how much?
50 cents.
50 cents, very small amount. Now, for your case, in your case, what happens? So the situation is like that. So you got the shares, instantly you received 50 cents. That's in your pocket. It's like rent in your house. When you buy a house, what do? You hope that the house price will go up. But do you keep it vacant? You find who? A tenant, instantly, who pays you some cash flow.
Is it 50 cents per share or is it
Per share,
So if he wants to buy 10 shares, he'll have to pay $5.
$5.
And why can't you pay it straight away, the $11? Because he doesn't have the money, so that's why he wants to pay.
People
only
prefer that.
$5.
They don't want to put a lot of money. They want to put a small outlay. We're going to talk about it. It's also return on investment. It's all about return on investment. We're going to talk. So there are two calculations here possible. One is that price stays below $11, and another is the price goes above $11. So the calculations like that. So first, I'm going to show you your calculation, your seller of the option. Okay, what happens? You bought the stock for $10. You invested. The next thing, you sold the covered call. It's called covered call. You sell call option and you receive 50 cents. The question for you, when do you receive this 50 cents? Straight away, not at the end of the contract. Same as when you get the money from your tenant, before they move to the house or after that. Definitely before. What can you do with 50 cents?
Depends how much you invest.
You can reinvest. Well, with 50 cents, you won't do much, but I mean, imagine that if it's $500. You probably can fly
You can
to
invest.
Tasmania and enjoy the air, right? Or no, not for 500. Okay, $5,000. What can you do? Fly to Bali and spend a month there, right? So it depends on the volume. So if you have $100,000 instead of 10, that would be $5,000. So you can live in Sydney there. Remember, it's US dollars. Okay? It's like Gazillion Australians. So two outcomes here. So first, if the price stays below $11, is that person who bought the call option from you going to buy shares at $11 if the share price, for example, $10.50? No. Why would they, right? If the price is higher. So what happens? Contract expires, you keep the shares, you have already your money. What can you do next?
Reinvest.
Sell them again.
You do it again, correct? The interesting thing here, how much money do you pay for shares? $10. How much money you generated? 50 cents. What's the cost of your share now? $9.50. You pay $10, you got 50 back straight away. So in reality, the cost of your share is only $9.50. Correct?
Yeah.
So what happens if the share price didn't move? It stayed on a $10 level. Did you make money or not?
The premium, you still made 50 cents.
You still made money. It regardless how much the price is right now, you still made 50 cents. What's a percentage term? 5% in this particular example. Now, who knows where the risk is?
Very risky. When the shares goes down at once.
Correct.
You lost all your coverage.
If the share price goes below, how much? $9.50. Because if it goes to $9.60, you're still making money. If it goes to $9.50, it's a break-even point called. If it goes below, you have what? Capital loss. You don't lose money until you sell your shares. But you're correct. If the share keeps going down, that's where the risk. So the question is, what kind of shares you can sell a call? And here there comes another rule. You sell the shares only on the stocks, on the companies which are solid. Good businesses which have a potential to grow. First rule. Second rule, they have to be undervalued. So during the program, education program, I'll give you a screener with the parameters which you have to insert in certain screeners, and those companies will come up. Do you know how many companies will pass this test? Assuming that 30,000 companies in the stock market.
Maybe 300.
50.
About 8 or 9 companies. Imagine. So when people go there without knowledge of these specific rules, majority of time gambling and having this risk, okay, open. When you put a proper screener, sometimes 0 companies, so I don't trade. When the market is so high, I don't do any trades at all. I'm sitting, I'm doing my stuff, I'm going out, I'm meeting friends, etc., etc. When the market is low, that's when I'm getting greedy. It's like 26th of December. What happens in Australia?
Boxing Day.
Boxing Day, everyone is going shopping. Nobody probably goes and buy any clothes before for 2 months, right? Because they know Boxing Day is coming. So the same thing. If I see the market is high, I know there has to be a correction. It's always correction. With Donald Trump, they are more often than ever before, you know, so he makes a lot of money for us, for traders, by creating this volatility in the market. So, all right, you understand it. The question is, even if the share price goes down, what can you do?
If they go down too much, maybe you can wait until.
You can wait, but can you sell another call?
Short.
If it is a bad company, you can short, you can reverse the trade. But the question is, if you have this share, can you sell another call?
The contract's still down on the other.
So if you say, get another contract and get another 50 cents, what happens with your break-even price? It goes to $9. So how many times you have to collect by 50 cents in order to bring your price, cost price to 0? 20 times. After that, you don't care what's the price of the share. So that's why this specific strike, even if the share goes down, you keep renting it, like I call it rent. You're selling covered calls, you're collecting premium on a monthly basis until the moment the price of your share is 0. Do you got that? Okay, that's the first part. What happens if the share price goes above $11?
Someone buy it. They're going to rush.
They're going to buy it from you for $11, and what? You exited the trade?
And you got your covered back.
Yeah, you get cash back. So you have 50 cents already, and then how much you made? $1. So what's your profit? 15%. Is it good or good?
Because obviously you gain as well on the money that the share goes up.
Correct.
So you got the $1 because the market goes up,
Correct.
plus the premium,
Correct.
plus all your capital back.
Correct. Cool? Isn't it fantastic? 15%, how many years you have to keep in the bank in order to get this money?
6 years.
Yeah.
Maybe 3% per year.
All right, okay. So here the risk is limited. So you get cash every time you sell covered call, every time. Your total profitability on the account will depend also on the stock, if it goes up or down. If it goes up, you are absolutely loaded with money, right? If it goes down, you keep the stock. You keep selling covered calls. It's like if you bought the property and property went down, do you keep tenant in the house? You don't sell the property if the price went down, right? You collect the premium from the tenant. Same story here, absolutely. Okay, let's go for another part. Why the person wants to do that trade? He puts only 50 cents there, and then if the share stays below $11, what happens with his 50 cents?
Just lost it.
No cash left. So what happens if the share price goes to roughly $12, assuming?
Then you can buy at 11 and get the premium.
Sell at 12, how much he makes? Dollar. Minus 50 cents which he invested. What's the profitability?
50 cents.
100%. 100%. Wow, cool. 1 month, 100%. Do you understand why people jump in on that side?
He's not a risky trade, but he
Risky trade. So he can lose everything, but he can make 100%, sometimes even more. So the question is, which side do you want to be on?
low risk side.
low risk,
Guaranteed profit.
guaranteed profit. Majority of people who don't get this picture as a whole, they choose that trade. Because they don't understand, they protect themselves, because the way they think about it, I'm putting $10 in a share, I'm risking already $10, here I'm putting only 50 cents, I'm risking only 50 cents. So they don't see that by choosing the correct share, quality share, correct business, it's not going to go to zero. Here, on the left side, it can go to zero completely. What happens with Apple, Facebook? Do you think they can drown? Not in the moment.
No,
You will
you
know
don't.
about it way in advance, okay, before something happens with those companies. So this is very important thing. So, and Warren Buffett says about all these derivatives and risky when you buy options, it's like, he said, even if you're 99% of the time right, and you make 90%, and then one time lose all your money, it's not good. You have to start from the beginning. So it's much better to generate 2 to 3 to 5% monthly basis. It's huge amount of money, especially in Australia. Okay, in some countries, because they want a higher profitability, it seems like, oh, I can find better deals. Okay, but in Australia, I mean, 2% probably annual banks paying.
Yeah.
So it's
No,
okay.